Welcome to this explainer. Okay, let's dive into this. Buying your first home in 2026 probably feels, well, practically impossible right now, right? Look, mortgage rates are sitting stubbornly at 6.5 to 7%. Prices are definitely elevated, and cash buyers just seem to be absolutely everywhere. I know most first-time buyers take one look at these numbers and kind of just give up before they even try. But here is what nobody is telling you. There are specialized programs and really precise insider strategies available right now that can literally save you $20,000 to $50,000 on your first home purchase. So let's completely demystify this process and get you those keys.
Here's the roadmap for our journey today. We're going to break this overwhelming process down into 6 highly actionable phases. We'll cover the 2026 market reality, building your financial foundation, pre-approval and insider programs, navigating the housing hunt, inspections in the closing process, and finally, preparing for hidden costs. All right, Phase 1, the 2026 market reality. Let's just get the brutal truth out of the way first.
We really have to address the elephant in the room here. Is 2026 actually a good time to buy a home? Here is the unvarnished truth. Mortgage rates are high. Prices are elevated, and honestly, experts don't expect massive price drops anytime soon because inventory is just way too low. But listen, if you're sitting on the sidelines waiting for rates to magically drop back to 3%, you are likely going to wait forever. Those rates were a once-in-a-generation anomaly. The real answer to this question, the absolute best time to buy a home is not when the market is perfect. The best time to buy is when you are financially ready. And this brilliantly illustrates exactly what we mean by financial readiness. It comes down to the buy versus rent framework. Buying makes total sense if you plan to stay put for about 5 to 7 years, if your total housing costs are within 5 to 10% of what you'd pay in rent, and crucially, this is huge, if your emergency fund stays fully intact after closing. Conversely, there is zero shame in renting. Renting is absolutely the strategic move if you plan to move within 3 years, or if buying would make you completely house poor with zero safety net. Buy when the personal math works for you, not when the headlines tell you to.
Moving on to Phase 2, building your financial foundation. Because foundational readiness completely trumps market timing.
Your entire buying situation is defined by 3 critical numbers before you even look at a single property listing online. Number 1, calculate your monthly gross income. That's your income before taxes are taken out. Number 2, determine your debt-to-income ratio, or DTI. You just divide all your monthly debt payments by your gross income. Lenders want this below 43%, and yes, that includes your future mortgage. Finally, number 3, pull your credit score right now.
Now, what's really interesting about this slide is the sheer scale of the savings. $36,000. That is the minimum amount of long-term savings you can generate on a standard $300,000 mortgage simply by bumping your credit score from a 680 up to a 760. You could even see savings up to $72,000 depending on the exact terms. That higher score lowers your interest rate by 0.5% to a full percent, saving you $100 to $200 every single month for 30 years. Spend 3 to 6 months optimizing your credit before you apply. Pay down balances, dispute any errors, and whatever you do, make every single payment on time.
So, once your credit is dialed in, it's time to bust the absolute biggest myth in real estate, the 20% down payment. Down payments require way less cash than you think. An FHA loan needs only 3.5% down, and if you qualify for a VA or USDA loan, you might need 0% down. Think about it. On a $300,000 home, 3.5% is just $10,500. The absolute smartest move you can make today is opening a dedicated high-yield savings account, earning 4.5 to 5% interest, and just automating your contributions every payday until you hit that exact goal.
Let's head into Phase 3, pre-approval and insider programs. This is where most first-time buyers miss out.
Okay, there is a hard line between being pre-qualified and pre-approved. Do not get these mixed up. Pre-qualification takes, 5 minutes online? It's a weak estimate based on whatever you self-report, and it means absolutely nothing to a serious seller. Pre-approval, on the other hand, means the lender has fully verified your income, your assets, and your credit, and they are committing to loan you a specific amount in writing. In a competitive 2026 market, sellers will literally laugh an offer out of the room if it doesn't come with a rock-solid, full pre-approval letter.
And here is a secret that lenders really don't want you to know. You can save at least $10,000 and sometimes up to $30,000 over the life of your loan simply by getting pre-approved by at least 3 different lenders and comparing their offers. And don't worry about hurting your credit score. All hard inquiries for mortgages within a 45-day window only count as a single inquiry. So please, shop around.
And while you're shopping, you need to ask about hidden first-time buyer programs. Aside from FHA loans, which only require a 580 credit score, there are down payment grants at the state and city level that can give you $5,000 to $25,000 in forgivable loans. That means you never have to pay them back. There's also the incredible Good Neighbor Next Door program, where teachers and first responders can actually buy eligible HUD homes for 50% off. And of course, VA and USDA loans that offer 0% down. These programs can drastically slash your out-of-pocket expenses.
All right, Phase 4, navigating the housing hunt. Time to assemble your team.
Your real estate agent is your most important ally, and the best part is you typically pay absolutely nothing for their services because the seller pays the commission. But you must vet them rigorously, ask for referrals, interview at least 3 agents, and specifically ask about their experience with first-time buyer programs. You also want to check their closing volume over the last 12 months. You want a highly active professional in your corner, not someone treating this as a weekend hobby.
Let's move to and see how this builds into making a highly strategic bid once you find the right property. Here are 5 rapid-fire strategies. First, research comparable sales from the past 3 to 6 months so you know the real value of the home. Second, in slower markets, don't be afraid to ask for seller concessions to help cover closing costs. Third and fourth, always include an inspection contingency and a financing contingency. This protects your earnest money if the home turns out to be a disaster or if your loan falls through. And finally, when you find a well-priced home, you have to move incredibly fast.
Which brings us to Phase 5, inspections and the closing process. You've got an accepted offer.
Now, I cannot stress this enough. Never skip the home inspection. Ever. Do not let anyone pressure you into waiving it. A home inspection only costs about $300 to $600, but it completely protects you from buying a home with hidden disasters in the roof, the foundation, or the plumbing. And just to be super clear, this is entirely separate from the lender's appraisal. The appraisal just tells the bank what the home is worth on paper. The inspection tells you if the home is actually safe to live in.
So, from the day your offer is accepted, it's roughly a 30 to 45-day sprint right to the finish line. Around day 27, you'll receive your closing disclosure. Make sure you read every single number and ensure it matches your initial estimate. By day 30 or so, you'll wire your final funds, sign a literal mountain of paperwork, and finally get your keys. But here is my strictest warning of this entire explainer. During this highly sensitive 30-day window, do not make any large purchases. Do not open new credit accounts. Doing so can and will completely disqualify your mortgage at the 11th hour. Keep your finances entirely frozen.
Finally, Phase 6, preparing for hidden costs. This is a sobering but absolutely necessary reality check. So, the crucial point is that the down payment is not your only expense. Far from it. On a typical $300,000 home, closing costs are an extra $6,000 to $15,000 out of pocket. Then you have to factor in property taxes, home insurance, potential HOA fees, and PMI if you put less than 20% down. Plus, you need to budget roughly 1% of the home's value every single year just for basic maintenance. This breakdown proves exactly why that thorough, honest financial preparation we discussed back in Step 1 is so absolutely vital to your success as a homeowner.
Listen, buying your first home in 2026 is completely achievable if you follow this roadmap. You just have to fix your credit, save strategically, find the right insider programs, and protect yourself with those contingencies. But I really want to hear from you. What is your biggest obstacle right now? Are you struggling with high interest rates, finding that down payment, or just feeling totally overwhelmed by the whole process? Share your specific roadblock in the comments below. Keep saving, stay focused, and trust me, you will get those